Welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. So this is your chance to ask questions and get answers. Use the chat to ask questions on today's topic or anything else for that matter surrounding solo 401ks as well as self-directed IRAs. Go ahead and type them over so that we can be sure to get to them all. So today's topic is a big one. Mandatory Roth Catch-Up contributions for certain high-earning solo 401k participants starting in year 2026. This is a rule that Congress passed, then the IRS delayed it, and now it's officially going live starting January 1st of 2026. All right. So if you are age 50 or over or turning 50 soon, then this is going to affect your planning, possibly your taxes, definitely your contribution strategy, and very likely your solo 401k setup. So are you ready? Because again, these rules are going to be implemented starting January 1st of 2026. So next month, effectively. So what are mandatory Roth solo 401k catch-up contributions? So they stem from Secure Act 2.0. That's where legislation was first introduced regarding requiring that catch-up contributions for those who are age 50 or older. So for example, the catch-up contribution for 2026 is $8,000. It increased $500 from 2025. And then there's the super catch-up contribution, which is $11,250. That one there is for those who are age 60, 61, 62, or 63 in tax year 2026. So both normal catch-up contributions and super catch-up contributions are going to be impacted as a result of this new legislation that's effective January 1st of 2026. Now, it doesn't apply to all solo 401k plans. It basically applies to self-employed businesses where you receive a W-2 from your self-employed business. So who must make Roth catch-up contributions if they're going to make any type of catch-up contribution? So you would not be able to make the catch-up contribution, whether the normal catch-up contribution or the super catch-up contribution, as a pre-tax solo 401k contribution, which reduces your taxable income for the year. They would need to be applied as Roth solo 401k catch-up contributions. Now, those who are impacted are S corporation self-employed businesses, C corporation self-employed businesses, as well as LLC self-employed businesses that are taxed as an S corporation or C corporation. Therefore, if your self-employed business is a sole proprietorship or a partnership, then this new legislation currently does not apply to those types of self-employed businesses. So in short, both sole proprietorship and partnership self-employed businesses are exempt from the mandatory Roth catch-up contributions. And again, it only applies to catch-up and super catch-up contributions. And the income that's going to be used, which is going to be indexed for inflation going forward, to determine whether or not you have to make that catch-up or super catch-up contribution because your business is taxed as an S corporation or a C corporation. It's going to be $150,000 of W-2 wages from that self-employed business. So if your W-2 wages are less than $150,000, then you would not be subject to this mandatory Roth solo 401k catch-up regulation. So make note of that. So we've talked about who's exempt. We've talked about how sole proprietors and partnerships are exempt. Reason being is that sole proprietorship businesses and partnership self-employed businesses, they don't report earned income from self-employment activity from their W-2. It's instead, if it's a sole proprietorship, it's going to be based on line 31 of your Schedule C. If it's a partnership, it's going to be based on Form 1065, I think line 14 with the Code A. It's titled self-employment income. So that's why this regulation does not apply to sole proprietorships and partnerships. It only applies, again, to S corporations, C corporations, as well as an LLC tax as a C corporation or S corporation. But again, it only applies to those entities so it only applies to an S corp or C corp if your W-2 wages from that business is greater than $150,000. And again, it's expected to change every year, that threshold amount based on inflation. Okay. Now, if you have a solo 401k plan that doesn't allow for Roth solo 401k contributions, then your plan would have to be amended. Well, here at my solo 401k financial, all our solo 401k plans already allow for both catch-up contributions, whether normal catch-up contributions, super catch-up contributions, as well as Roth solo 401k contributions. So your plan would not need to be amended. Now, for those that have solo 401ks with other institutions out there, and if that institution does not allow for Roth solo 401k contributions, then you wouldn't be able to make any catch-up contribution to that solo 401k, whether a pre-tax solo 401k catch-up, and of course not a Roth solo 401k catch-up, so you may need to change solo 401k providers. That probably explains why Schwab and Fidelity now allow for Roth solo 401k contributions. They did not allow for Roth solo 401k contributions a few years ago, but last year into this year, they changed their rules to allow for Roth solo 401k catch-up contributions. And that was probably in preparation of this new law mandating that Roth solo 401k catch-up contributions for S Corps, C Corps, LLCs taxed as an S Corp, LLC taxed as a C Corp, that those individuals who make over $150,000 in W-2 wages are now going to have to treat those catch-up contributions as Roth solo 401k contributions. They can no longer be treated as pre-tax solo 401k contributions. So that probably explains, again, why Fidelity and Schwab are now providing a solo 401k that allows for Roth solo 401k contributions. So here are some key dates to understand regarding the new mandatory Roth catch-up contributions. So it takes effect January 1st of 2026. Now, the IRS is going to start fully enforcing this mandatory catch-up starting January 1st of 2027. So what should you do in tax year 2025 in preparation? Well, you want to review your W-2 wages for tax year 2025. So oftentimes when you're self-employed, you actually have control over how much salary you're going to pay yourself. So if you're an S corporation or a C corporation, self-employed business, or an LLC taxed as an S corporation or C corporation, from a planning perspective, you may want to pay yourself less than $150,000. So $150,000 or less of W-2 wages from your self-employed S corp or C corp. So that way you won't be subject to this mandatory Roth Solo 401k catch-up contribution. And again, you want to make sure that the Solo 401k plan that you have allows for Roth Solo 401k contributions as well as catch-up contributions. And again, all plans from my Solo 401k Financial. So if you're a client of my Solo 401k Financial, then your plan is already set up to allow for both Roth Solo 401k contributions as well as super catch-up and normal catch-up contributions. And again, the super catch-up contribution applies to those who are ages 60, 61, 62, or 63 in tax year 2026. If you are under age 60, then, but you're over age 50, then you would qualify for the $8,000 normal catch-up contribution. If you're age 64 or older, then you would qualify for the $8,000 normal catch-up contribution as well. So here are some common questions that we get. Does this affect employer contributions? Good question. No, it does not. Why? Well, number one, catch-up contributions and super catch-up contributions are part of employee contributions. They're not part of employer contributions. Employer contributions can be made as pre-tax or as Roth Solo 401k contributions, and those are calculated based on a percentage. For example, if you pay yourself at least $100,000 of W-2 wages from your self-employed S corporation, you can contribute 25% of $100,000, which would be $25,000 as an employer profit sharing contribution, and that can be applied as a pre-tax employer profit sharing contribution or as a Roth profit sharing Solo 401k contribution. Does it impact the mega backdoor Roth strategy? No, it does not. Why? Because again, this regulation applies to catch-up contributions. The mega backdoor Roth Solo 401k strategy, you can never treat the catch-up contributions as part of the mega backdoor Roth Solo 401k strategy. Remember, the mega backdoor Roth Solo 401k strategy requires that you make a voluntary after-tax Solo 401k contribution. The maximum you can make is the 415C overall limit, which is $70,000 for tax year 2025. And for tax year 2026, it increased by $2,000 to $72,000. So voluntary after-tax Solo 401k contributions, once you make those, they get converted to the Roth Solo 401k. You can never apply the normal catch-up or the super catch-up contribution as a voluntary after-tax Solo 401k contribution, which is part of the mega backdoor Roth Solo 401k strategy. Another question, can I avoid this mandatory Roth catch-up by adjusting my W-2 wages for my self-employed business? As I stated earlier, possibly and most likely. Why? Because when you're self-employed, you get to control the salary that you make from that business. So yes, you should work with your payroll provider, or more importantly, with your CPA or tax professional in strategizing whether or not you should adjust your W-2 wages if you're an S Corp or C Corp, LLC taxed as an S Corp, or an LLC taxed as an S corporation. So you're going to want to do that. So you can try to determine whether or not you want to try to stay below that $150,000 threshold so that you will not be subject to those mandatory catch-up contributions. Okay. So some takeaways from all of this. Mandatory Roth catch-ups begin 2026 for high-earning W-2 owners. That translates to self-employed S corporations, self-employed C corporations, as well as self-employed LLCs taxed as an S corp or C corp. Sole proprietors and partnerships are unaffected by this regulation. Okay, let's take a, now, another question we get is, okay, what line number of the W-2 wages do I need to use for this threshold? So you're going to want to look at line 3 of your W-2, or box 3 specifically, which is the Social Security wages. Let's see if I can dig something up here. Give me a moment here. You can probably just go ahead and pull up a W-2 on YouTube and take a look at that. And you're going to want to look at box 3 of that W-2. So not box 1. Box 1 is the gross wages, which is what you use to calculate solo 401k contributions. But the rule specifically looks at box 3 of the W-2, which basically represents wages subject to Social Security tax. So you want to look at box 3. That's the one you want to look to see if it's greater than $150,000. If it is, then you are going to be mandated to make those super or normal catch-up contributions as Roth solo 401k contributions if you want to make catch-up or super catch-up contributions. Obviously, you're not required to make those contributions. Okay, let's take a look at some questions here, and then we'll continue going over this important topic here. Let's see here. I just want to make sure I completed the right form. I had just moved funds into my solo 401k after-tax account and then moved them over again to the after-tax account into the Roth 401k. This form I completed and submitted the after-tax to Roth Solo 401k in-plan conversion. Did I complete the right form? Any additional forms I need to complete? What is the next steps in your produced documents when I can expect them? So it sounds like you converted voluntary after-tax Solo 401k funds to the Roth Solo 401k, and you completed the conversion form on our website titled After Tax to Roth Solo 401k. So yes, that's the right form. So it looks like you put money into this bucket here, the voluntary after tax Solo 401k bucket, and then you move the funds to the Roth Solo 401k. So now what's going to happen is that we're going to go ahead and issue a Form 1099-R to the IRS, and that would be issued January or February of next year with the copies emailed to you via download file and a copy submitted to the IRS. So good question. Now it's worth noting that if you want to process a pre-tax solo 401k conversion and you want it to be effective for tax year 2026, you need to make sure that you convert those funds from the pre-tax solo 401k bucket, so this bucket right here, to the Roth Solo 401k bucket, and you need to do that by December 31st of 2025 if you want to count it for tax year 2025. Now, from the mega backdoor Roth side of things, it's not as important to convert those voluntary after-tax solo 401k funds in 2025 to the Roth Solo 401k. Why? Well, it's not going to be taxable. So whether those funds get converted here in 2025 or you process the conversion in 2026, it's not going to matter because it's going to be a non-taxable event. There might be a few gains, but it's not going to be a taxable event. It's going to be reportable. So whether it gets reported on a tax year 2025 Form 1099-R or a tax year 2026 Form 1099-R, doesn't matter. But if they are pre-tax solo 401k contributions, it is going to matter because those are going to be subject to taxes in the year of conversion. What is more, if you process the mega backdoor Roth Solo 401k conversion in 2026, that's not going to impact whether or not you can do another one in 2026. For example, let's say you make a voluntary after-tax solo 401k contribution for tax year 2025 and tax year 2026, and then you make another contribution, another voluntary after-tax solo 401k contribution in tax year 2026 for tax year 2026, and you convert both amounts. That's fine because, again, voluntary after-tax solo 401k contributions don't have to be converted in the same year that the contribution is made. So make note of that for people who are trying to get the plan set up by the end of the year. All you need to do by the end of the year, if you're trying to utilize the Make It Back to a Roth Solo 401k strategy, and you're opening a Solo 401k for the first time, is simply sign the Solo 401k plan documents that we draft the same day. Once you sign those documents, your plan is effective for tax year 2025, and therefore you can wait until 2026 to both open the Solo 401k holding accounts, aka bank or brokerage accounts, and make the annual Solo 401k contributions, whether employee, employer, voluntary after-tax contributions. You'll have until your business tax return due date, plus timely filed extension in 2026 to make those year 2025 Solo 401k contributions, all types. Okay, let's see what other questions we have here. When the after-tax label bank or fidelity account is open under the Solo 401k plan, all contributions going into this bucket have specific year marked like 2025 or 2026 to contribute. Or will it be just any normal bank or brokerage account? Do bank or brokerage accounts report contributions to your agency, or we trustees have to track and monitor contributions? It's very easy. It's not as complicated as it sounds. IRS created Solo 401k plans for one reason, actually two reasons. To make it easy for self-employed individuals to save for retirement, and number two, to easily administer the Solo 401k plan. So number one, the contributions are going to the voluntary after-tax Solo 401k bucket. So that's why when you open a Solo 401k, you're going to have three separate holding accounts. You're going to have, and that translates to three separate brokerage accounts. If you look at this slide here, it's one plan with three separate brokerage accounts. One to hold the pre-tax Solo 401k funds, the second to hold the Roth Solo 401k funds, and the third one to hold the voluntary after-tax Solo 401k funds. Hence, these brokerage accounts, that's how you track the contributions. So you don't need to do any spreadsheet tracking. You can if you want to overkill something, but it's not necessary. That's the whole purpose of the separate brokerage accounts, to make the contributions into those brokerage accounts, and that's how the contributions are tracked. Keep in mind that voluntary after-tax Solo 401k contributions are typically now reported on your taxes. Why? Because you're not getting a deduction for those contributions. Instead, those voluntary after-tax Solo 401k contributions are going to be indirectly reported to the IRS when you process the conversion. When you move the funds from the voluntary after-tax Solo 401k to the Roth Solo 401k, and if you're a client of my Solo 401k Financial and you timely request this service, we'll issue a Form 1099-R. On that Form 1099-R, the voluntary after-tax Solo 401k contribution is reported on that Form 1099-R. I think it's in box 5 of the Form 1099-R. That's where you report the voluntary after-tax Solo 401k contribution. In box 1 of the Form 1099-R, you're going to report the gross amount converted from the voluntary after-tax Solo 401k to the Roth Solo 401k. In box 2A, you're going to list the taxable amount, which is typically zero. There might be a little bit of interest, maybe $1 or $2, or a few pennies, or a nickel, or a dime, quarter, $0.50, 50 cents, whatever. That'll get reported in that box 2A. So don't make things hard on yourself. Again, the whole purpose of the voluntary after-tax Solo 401k and all the separate brokerage accounts is to track the contributions. You don't need to track them on a spreadsheet. And again, they get reported in a Form 1099-R. We've been processing these Make It Back to a Roth Solo 401k conversion since 2014. We've processed thousands of these and I've never had any issues. So don't make things tough on yourself. Okay, let's see if we have some more questions here. Paying kids part-time wages, W-2, 1099, for less than 500 hours, the aligns with S-Corp structure and clean for expense. Well, number one, the Solo 401k plan does not allow for participants who are under age 21. So whether your kids are working 1,000 hours, 1,000,000 hours, 2 hours, 50 hours, it doesn't matter, because you can always exclude anyone who's under age 21 from participating in the solo 401k plan. If you're trying to add your kids to the plan and they're under age 21, they cannot be added. But let's just entertain for a minute here that you have a son who's age 22. If you want to add him to the plan so that he can contribute to the solo 401k plan, he would need to be at least a 3% or more owner in your self-employed business. He would need to be both an owner and an employee in business. The plan would need to be amended, and then he would need to have separate holding accounts to hold his contributions. But in short, if your son or daughter is under age 21, he or she is excluded from the plan because the plan does not allow for anyone who's under age 21 to participate in the solo 401k plan. All right, let's see if we have some more questions here. Is it necessary to close an existing non-loan eligible in order to open a loan eligible? So if you currently have a solo 401k plan, let's say at Fidelity, which obviously does not allow for solo 401k participant loans, you do not want to close that plan down. If you close that plan down, you're going to have to wait 12 months before you can open another solo 401k plan. That's referred to as the cooling off period, which is an IRS regulation that was put in place to keep individuals from churning solo 401k plans. Instead, you're going to want to restate. Restate means you want to move that solo 401k plan to a solo 401k offered by my solo 401k financial, for example, that allows for solo 401k participant loans. When you complete our online application, if you use our services, one of the questions we ask on the online application is, are you currently participating in a solo 401k plan? In your case, you would say yes. We also ask for the original effective date of that solo 401k plan. So you're going to want to enter the date that you first opened that solo 401k plan with my solo 401k financial. Okay? And then, if let's say your plan is at Fidelity, we can help you open up new brokerage accounts at Fidelity for the solo 401k that we offer, and then to internally move that existing Fidelity solo 401k to the solo 401k plan offered by my solo 401k financial. If it's done as a restatement, that means that Fidelity will not issue a Form 1099-R, nor will you issue a final Form 5500 Easy, because you're not closing the plan. You're effectively changing providers from Fidelity to my solo 401k financial. Good question there. Let's see if we have some more questions here. Looks like everybody woke up on a Monday with a lot of questions from a long weekend. Give me a moment here. Could you please provide me links, documents, so my CPA can quickly get up to speed regarding the treatment of opening an account for my solo 401k account? Yeah, you just need to go to our website. It's mysolo401k.net. I mean, we have all kinds of information in there. If you search our box on the right-hand corner, there's a search box. We have all kinds of topics there. And your CPA can get educated. We have a lot of CPAs and attorneys that utilize our website to educate themselves and their clients. You can also visit our community. Share in my community with your CPA or tax professional, where we have over 32,000 members who are constantly posting forum posts. There are guest blog posts out there put on by professionals, advisors, CPAs, attorneys. That's a great way to get educated. But yes, our website is full of great information. You can also share IRS publication number 560 with your CPA, which is the publication for self-employed plans, including solo 401k plans. Help spread the word out there. Okay, here we go. Another question here. Give me a moment here. So I have 2 part-time employees, both under 21. I'm learning that California is making it mandatory for me to provide some retirement savings plan for them by December 31st. Can I open a solo 401k now for 2025 and still be able to use Cal Savers for my part-time employee under 21? Or what options are available for people in my situation? Good question. Let me pull up a page that we put together on this. Bottom line is, yes, you can open a solo 401k plan. Second, you're not going to have to worry about the new California mandate. Why? Because as long as you employ W-2 employees who are working less than 1,000 hours in the first year, so 12-month period, you can exclude those individuals from the plan. Now, if you hire W-2 employees that work between 500 and 999 hours for 2 consecutive 12-month periods, then that would also require closing the plan. So you're okay as long as you don't employ a W-2 employee who works 1,000 hours or more during the 12-month period. That's rule number 1. And then there's the part-time rule, which is you don't employ a W-2 employee that works between 500 and 999 hours for 2 consecutive 12-month periods. I'm trying to find that post from our website. Give me a moment here so I can share that with you. If I can, oh, here we go, Cal Savers. Yes, so here's a good page to read. So bottom line is that as long as you keep those W-2 employees under that hour requirement there, you're going to be fine. Take a look at that link I just shared. It's right there. Take a look at that. Now, let's say that you do employ a W-2 employee who works 1,000 hours or more for 12 months. Then at that time, you're going to have to close the plan down. You cannot continue with both a solo 401k plan and a mandated Cal Savers 401k plan. Because once you have a W-2 employee who works 1,000 hours or more for 12 consecutive months, then it's an IRS requirement that you can no longer participate in a solo 401k plan. It doesn't matter whether you open another one and then you keep yours just for you, you cannot have a solo 401k. You cannot continue with it. Again, not to keep talking about it, but also there's that part-time rule, part-time W-2 employee rule. If you employ a W-2 employee who works between 500 and 999 hours for 2 consecutive 12-month periods, and that means you can no longer continue with the solo 401k plan. So that link I just shared with you is also a good reference on how to complete that Cal Savers form questionnaire that you need to fill out for to communicate that you qualify for a solo 401k plan, and hence why you're not participating in the Cal Savers savings program. Okay, let's keep going here. Give me one moment here while I look for some more questions here. Are you able to get catch-up contributions the year you turn 50? Yes, you can. So if you turn 50 here in 2025, then yes, you qualify for the normal catch-up contribution for tax year 2025, which is $7,500, and you actually have until next year in 2026 by your business tax return due date plus timely filed extension to make that normal catch-up contribution. So if you already have a plan, you don't need to worry about having to make that contribution by December 31st. If you need to open a solo 401k plan for the first time, then you want to open that plan by December 31st of 2025 so that you can make that employee contribution next year in 2026 for tax year 2025. Okay. Let's see here. question. Does the under 150,000 exemption consider income of your spouse if you file jointly? So no, it's per employee. So if you and your spouse are both self-employed in the same S corporation or C corporation, and therefore you both participate in the same solo 401k plan, because the plan is sponsored by the self-employed business, then each of you will have to have your own separate W-2. So it's based on each separate employee's W-2 wages. Because keep in mind, when you make contributions to a solo 401k plan, and if both you and your spouse are self-employed in the same S corporation, for example, you're each going to need to have separate holding accounts under the plan. So it's considered one plan, which is sponsored by the business, but both spouses can participate in the same solo 401k plan as long as they're both self-employed in the same business. So each of you would have your own separate W-2, and you would calculate that $150,000 wage to determine whether or not you're going to be subject to that mandatory catch-up contribution. So it's on a per participant, per spouse basis. Your W-2 wages would not be aggregated, in other words. Good question. Okay, so here's an example of a two-participant plan where both spouses participate in the same plan. They would each have a total of 3 separate holding accounts, aka bank or brokerage accounts, to hold their separate pre-tax, Roth, and voluntary after-tax solo 401k funds. So a total of 6 holding accounts, 3 for each. All right, let's keep going here. A lot of good questions today. Let's see if we have some more questions here. Do you only do solo 401k with Schwab's or Fidelity? Well, we offer solo 401k plans. Our clients get to choose where they want to hold their money at. A lot of our clients like to have their funds held at Fidelity, Schwab, their local bank. Also, we have a lot of institutional advisor clients. They like to use Altruist to hold the funds for their clients. They'll even use Fidelity and Schwab on the institutional side. But one of the reasons we get a lot of clients is because we don't hold your funds and we let you choose where to hold the money at. At the end of the day, it's your money, so you should choose where to hold it at. It just comes down as to whether or not the brokerage or bank that you use will hold the funds. So we don't put restrictions on where our clients hold their funds. What happens if I open a solo 401k for 2025 and the next year I end up hiring a full-time employee? Well, if you hire a full-time W-2 employee in 2026 who's over age 21, and once that individual works 1,000 hours for 12 consecutive months, then you're going to have to close the plan down and transfer it to an IRA or convert it to a full-time employer 401k. So you would need to make sure that that W-2 employee does not work 1,000 hours or more during a 12-month period. Let me see if I can send you a link that talks about that more. Give me a moment here. Here's the link here. Take a look at that link there to a page from our website. Okay, let's see here. Give me a moment here while I keep going through some of these questions here. If I open a solo 401k with you, I'll be able to call someone at my solo 401k if I have questions later on. Certainly, all our calls are scheduled, so you'll be able to schedule a call, and that way we can make sure we have you speak to the right professional to answer your particular questions. Also, you can join our daily webinar to ask general questions. You can also email us your questions. We get a lot of email questions, especially for contribution calculations, investment scenarios, distribution regulations, contribution regulations, mega backdoor Roth regulations. That way we can lay it out nicely in an email, and then you can share it with your tax professional. But yes, you can schedule calls with us. We're on the phone constantly every day, going over client questions with clients for scheduled calls. Okay. This is my first full year of a 401k plan. In addition to the conversion forms, what other forms and info do I need to ensure I submit to my solo 401k by year in 2025? Good question. Let me pull up some information here to share with you. So, give me a moment. So here is my solo 401k financial. Not only are we the solo 401k plan document provider, that's the reason for our annual fee. If you look at our pricing website, you'll notice that our flat annual fee is only $125, and that's for being the plan document provider. However, we also provide other services at no additional cost for clients who timely request it. For example, a Form 1099-R. That Form 1099-R is used to report distributions. For example, let's say you take a required minimum distribution because you're age 73 or older, or if you take a hardship distribution, or if you take a qualified distribution, or if you close the plan down and transfer it to an IRA. All those transactions need to be reported in a Form 1099-R. And if you do any of those transactions in 2025, you need to make sure that you complete our online request form so that we issue that Form 1099-R. You can go to our Forms tab of our website. On the top right-hand corner, you'll see all the different forms listed that you would fill out for distributions and conversions. So that's number one. Number two, a Form 5500 Easy. Once the fair market value of your solo 401k plan is greater than $250,000 as of December 31st, for example, a Form 5500 Easy will need to be filed by July 31st of the following year. So if the market value of your solo 401k plan is greater than $250,000, the market value is at the end of this year, you're going to want to let us know so that we can add you to our annual Form 5500 Easy preparation list. And then we'll automatically prepare that Form 5500 Easy for you next year, where we'll collect some information for you, and then we'll file it with the IRS. So technically, you have until next year to communicate to us if the market value of your solo 401k plan was greater than $250,000 as of December 31st of this year. You want to let us know sometime in the spring, because again, that Form 5500 Easy is due by July 31st of next year if the market value was greater than $250,000. All right. Also, other reporting that would need to be done by the end of the year really has to do more with if you're trying to perform an in-plan Roth pre-tax solo 401k contribution. Because keep in mind, when you convert pre-tax solo 401k funds to the Roth solo 401k, that's a taxable event, and you're going to have to pay taxes based on the value of that conversion, which might bump you into a higher tax bracket. So from a planning perspective, you would want to process that conversion and tax year 2025 if you know you're going to be in a higher tax bracket for 2026 versus 2025. So from a planning perspective, you would want to process that conversion here in 2025. And as long as you request these forms here that I went over on a timely basis, we'll prepare those for you at no additional cost. Okay, let's see if we have some more questions here. Let's see what we've got going on here. I signed up at the start of the year for the solo 401k. I thought it would lower my taxes, but my adjusted tax rate is so low it did not provide a deduction. In my 30s, I also want to access to my funds. Let's see here. I just need to know what happens during tax season in April. I'm not sure what to do yet. Well, I don't quite understand, but I'll take a stab at what you're saying here. So, let's see here. So yeah, I mean, if you don't have enough earned income from self-employment activity to make contributions, then you cannot contribute. You can only contribute to the solo 401k in years that you have enough net self-employment income. Keep in mind that a solo 401k plan is meant to save for retirement. It's not meant to be used in your 30s. That's the same thing for IRAs as well. They're retirement accounts. So you may want to talk to your financial advisor about maybe opening also a personal brokerage account where you might be able to invest and have access to funds. Those are non-retirement type of accounts, but yeah, I don't quite understand your question there. Okay, let's see here. But yeah, I mean, from a tax perspective, if you did not contribute to the plan, then you don't get any tax deductions. So you wouldn't need to report any contributions on your taxes next year. Here's a question here. 455 and easy has to be filed under the market value combined of spouse or more than 250,000. Yes, keep in mind that that 455 easy applies to the entire plan. So if both spouses are self-employed in the same business, you would add all the funds in that solo 401k plan. So your funds and your spouse's funds. And when added together, if the total market value is greater than 250,000, then the Form 55 easy needs to be filed with the government. So you got to add all the funds in the solo 401k plan. It's on a per plan basis. Good question. Just to be sure, a small business owner can have a solo 401k providing all other requirements are met, even if the spouse participates in a 401k at their place of employment and regardless of their spouse's income. So yes, if just one spouse is self-employed and the other spouse is working at a daytime employer, then yes, you can open a solo 401k plan and you would be able to make contributions to the solo 401k plan. If your spouse later becomes self-employed in your business as well, she can also participate in your solo 401k plan and you would each have separate holding accounts. And even though she maxes out her daytime employer 401k contributions, she would still be able to max out her mega backdoor Roth solo 401k contributions because the mega backdoor Roth consists of voluntary after-tax solo 401k contributions, and those are never aggregated with contributions made to a daytime employer 401k. So your spouse could really supercharge her retirement savings by maxing out her daytime employer 401k contributions and then her voluntary after-tax solo 401k contributions to her solo 401k. The only type of contributions that are aggregated between a daytime employer 401k and a solo 401k for the same spouse are employee contributions. Employer contributions are not aggregated either. So that's why we have a lot of clients that have a daytime job 401k that they contribute to, and then they also have a side business and they open a solo 401k plan and they'll perform the mega backdoor Roth solo 401k strategy. For example, for tax year 2025, they'll make a $70,000 voluntary after-tax solo 401k contribution and then convert it to the Roth solo 401k, even if they've already contributed $70,000 to their daytime job 401k. Of course, the contribution to the solo 401k would have to be based on their earned self-employment income from their self-employed business, not from their day job employer. So yes, that's certainly available under the regulations. Let's see here. Here's another question here. I want to confirm that it is acceptable for contributions to all 401k brokerage accounts, pre-tax, Roth, and after-tax, can be made from a personal or business account. Well, number one, contributions to the solo 401k plan, whether they're employee contributions, employer contributions, Roth contributions, voluntary after-tax solo 401k contributions, those have to be based on your earned self-employment income from your business. So as long as you have the necessary earned self-employment income from your business, the contribution can be made by your business tax return due date plus timely filed extension next year in 2026, if you already have a solo 401k plan or if you open one up here in 2025. And whether the contribution flows from your personal bank account or your personal or your business bank account, it doesn't matter. What matters is that you have the darn self-employment activity to support that contribution. Okay, let's see here. If we have some more questions here. Here's another good question. If a company has seasonal employees to work less than 1,000 per year and never more than 4 months of any year, can a solo 401k remain in effect by excluding employees as a class who never complete 6 months of work? Yeah, so what you're mentioning really is used more for traditional 401k plans. Those are plans that employ W-2 employees where you can typically exempt certain class of employees. So don't apply those rules to a solo 401k plan. So with the solo 401k plan, as long as that employee does not work 1,000 hours or more during the year, during the 12-month period, then that individual can be excluded from the solo 401k plan. Now, you also have to take into account a part-time W-2 employee, where if you employ a W-2 employee who works between 500 and 999 hours for 2 consecutive 12-month periods, then you would no longer qualify for a solo 401k plan. So it doesn't matter whether they complete those, if they work 600 hours and it takes them 2 months, they can still be excluded if they haven't worked 1,000 hours. But if they're part-time and they work 300 hours, then obviously they haven't met that 500-hour requirement. Whether they work 300 hours in 1 month or in 12 months, it doesn't matter. Okay. Let's see what we got going on here. Most of our investments are with Vanguard. So late last month, we opened a solo 401k plan with the census. Unfortunately, we've since changed our minds about using the census, but we already made payroll worth contribution of roughly $2,100. If you open a solo 401k for us, can that money sitting in the census be moved into the solo 401k plan? Certainly. We actually restate plans from a census all the time to our solo 401k plan, and our clients will use Fidelity Investments to hold the solo 401k funds. So when you complete our online application, we're going to ask for the original effective date of that plan. So you're going to put the original effective date of your census solo 401k plan on that line there on our application. Then we'll prepare the plan documents for your signature. Then we'll help you to open up the brokerage accounts at Fidelity so that you can then transfer those funds from that census solo 401k over to the Fidelity brokerage accounts for the solo 401k plan that we offer. And then going forward, you can make contributions directly into those Fidelity brokerage accounts, and you're going to be able to actually link your business bank account to those Fidelity brokerage accounts so that you can make contributions electronically via ACH. We have instructions on how to link your business bank account to those Fidelity brokerage accounts, and that's going to be done on your bank side of your business bank account. You'll link those to those Fidelity brokerage accounts to make those monthly or bi-weekly contributions. Remember, solo 401k contributions don't have to flow through payroll either. They can be made monthly, quarterly, all in one swoop at the end of the year or by the business tax return due date, plus timely filed extension. But the fact that you've already made a payroll contribution does not impact your ability to still restate that existing Ascensus Solo 401k to a Solo 401k plan offered by my Solo 401k Financial. Will fill out the applicable Ascensus, what they refer to as a deconversion form, to get Ascensus to move those funds over to the new brokerage accounts at Fidelity for the Solo 401k that we offer. Ascensus can be a little tough to work with when you're trying to move funds out of there. So oftentimes we have to get on the phone with Ascensus and kind of rile them up a little bit to get them to release those funds. For some reason, they like to hold on to the funds, but we've processed easily a few thousand conversions of Ascensus Solo 401k plans to a Solo 401k offered by my Solo 401k Financial, especially after they purchased the individual 401k plans from Vanguard. I think last year we easily processed over 1,000 restatements from Ascensus to a Solo 401k offered by my Solo 401k Financial, stemming from that Ascensus purchase of the Vanguard individual 401k business. Okay. Let's see if we have some more questions here. Here's a comment here. My wife's the business owner and I am her sole employee. We both want to be able to contribute the max and utilize the mega backdoor Roth option. That's certainly doable. So the Solo 401k plan would be sponsored by the self-employed business. If you look at this slide here, this is an example of a two-participant plan, aka both spouses are self-employed in the same business. You're both going to be able to maximize the mega backdoor Roth conversion. So each of you would have separate holding accounts. Let's say you use Fidelity or Schwab to hold the funds for the plan that we offer. Then you'll be able to make these contributions. You don't have to make pre-tax contributions or Roth contributions. Each of you can decide to solely make voluntary after-tax Solo 401k contributions. So if each of you have enough net self-employment income from that business for tax year 2025, each of you could contribute $70,000 to each of your respective voluntary after-tax Solo 401k buckets, aka brokerage accounts or bank accounts. So a total of $140,000 between the two of you. And then you can each convert that $70,000 to the Roth Solo 401k. And now you both end up with $140,000 in Roth Solo 401k funds. Talk about really supercharging your retirement account. I mean, this is the best things in sliced bread, in my opinion. And now you're going to have tax-free growth. So yes, certainly. How do I schedule a call with my Solo 401k consultant that you mentioned earlier? You can go to our website to schedule a call. Give me a minute here. And I will get that. I'll send you the link here to schedule a call. Okay, here's the link here where you can use to schedule a call. You can also email us your questions ahead of time, so that way when we assign you to the right person to speak, we can make sure we assign you to the right representative. Okay. If my current Solo 401k at Fidelity has only pre-tax contributions in it, when I move the plan to my Solo 401k, will I only need to open one brokerage account at Fidelity since I don't have or plan to have Roth or after-tax contributions in the plan? Great question. So that's exactly right. Even though our plan has all the bells and whistles, which allows for not only Roth Solo 401k contributions as well as voluntary after-tax Solo 401k contributions as part of the Mega Backdoor Roth strategy, you're not required to make all these contribution types. What is more, if you don't make these contribution types, that doesn't mean you're going to lose that capability. You can choose to just solely open up a brokerage account under the plan that we offer. Let's say a pre-tax Solo 401k brokerage account for now. We would help you transfer that existing Fidelity Solo 401k internally including any equities in the pre-tax solo 401k at Fidelity, to the new pre-tax solo 401k offered by my solo 401k, so that those positions are not liquidated. That is the stocks and mutual funds. Now later on, if you decide that you do want to make Roth solo 401k contributions or voluntary after-tax solo 401k contributions, we would assist you in opening up those additional brokerage accounts. It's not an additional solo 401k plan. It's still the same plan. It's usually we will help you open up additional holding accounts, aka brokerage accounts, to hold those funds. Okay. All right, looks like we went through all those questions. We've been on for over an hour. Time sure flies. So again, today's topic, well, at least for the first part, was the mandatory Roth Catch-Up contribution effective for January 1st of 2026. We didn't get too many questions on that topic, but let's finish this up here with some key takeaways. So the mandatory Roth Solo 401k catch-up contributions begin January 1st of 2026. It applies to employees earning more than $150,000 in Box 3 W-2 wages. It only applies to self-employed S corporations, C corporations, LLCs taxed as a C corporation, LLCs taxed as an S corporations. It does not apply to self-employed businesses that are sole proprietorships or partnerships. It affects all catch-up contributions, including the normal catch-up contribution, which is $8,000 for tax year 2026, and the super catch-up contribution for those who are ages 60 through 63, which is $11,250 for tax year 2026. So those are some key takeaways to understand here. Now let's do an illustration here. Let's say that Joe starts his own self-employed S corporation business, and he opens the self-employed S corporation business on July 1st of tax year 2026. Okay, at a salary, and he's going to get a salary of $300,000 for tax year 2026. And he opens a solo 401k plan. Well, Joe, he's going to be exempt from the Roth mandate for 2026 because Joe did not have any W-2 wages from his self-employed S corporation in 2025. So he's not going to have to make that Roth solo 401k contribution. He can treat it as a pre-tax solo 401k contribution if he wants. Now, let's say Joe earned $130,000 in W-2 wages in tax year 2026. Remember, the threshold is $150,000. It's over $150,000. So Joe is going to be exempt in 2027 because the wage threshold is not prorated. So he's under that $150,000 threshold. He made $130,000 in W-2 wages for tax year 2026. All right. I think I've run out of steam here. So we'll be live again tomorrow. So that's it for today, folks. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this community. We'll be back here again tomorrow with more great content. Until next time, have a great rest of the day.